This is part 3 of our 4-part series about price behavior, inflation, and deflation. Remember, this series is associated with the chapter I'm having you read about inflation, and this should be looked upon as a supplement to that chapter. In this little segment, we're actually going to cover 2 topics, both of them too short to include as a single video. We're going to talk about historical deflation in a few slides, and then we're going to do an inflation theory review of all that we have learned already about inflation using our models. And so we'll start with deflation. The cost of deflation sometimes can be regarded, I think, or by many are regarded as more serious potentially than the cost of inflation. That's debatable, to be sure, especially after I gave you the account of the Weimar Republic. But it's the inflation, I should say, of the Weimar Republic. But it is certainly the case that the deflation of the 1930s associated with the Great Depression really took a terrible toll upon the economy. Now, generally, as we're going to see here in just a moment, that was a general decline in the price level that was quite sizable, and it had the following effects. It made loans impossible to pay, and this was partly because we were largely an agricultural economy still in 1929, 1930, 31. About 80% of households still made their living in some way or the other from agriculture. And lending was largely agricultural lending and some mortgage lending. There wasn't much consumer lending going on at the time. And so a lot of the loans were agricultural loans. And so when prices started to fall for farmers' products like milk and wheat and the like, then it was very difficult for the farmers to make the nominal loan payments that they owed to the bank. Because, of course, the loan contracts were simply contracted in dollars that are not adjusted for inflation or deflation. Because there was such a high level of foreclosure and bankruptcy, that threatened not only the largest industry in the United States at the time, farming, but it also threatened the banking structure and, in fact, effectively destroyed the banking structure. The deflation, again, simply made it very difficult for anyone to repay the loans. You could imagine, for example, if you have a car loan now, let us say you have a mortgage for $3,000 a month, which would be perhaps typical in the Southern California area, and you have a job that more than pays for that, but your job is working for a business where you're selling things. And suppose all of a sudden the prices on what you're selling start to decline by 10%, then 15%, then 20%. 25% and even more, which is what happened to some farm products. Well, the revenue that flows into your household account that is used to pay that mortgage falls, but the monthly mortgage payment is still there at $3,000 a month, so you default. You fail, and the bank fails if enough of them did that. This was such a substantial crisis that when President Roosevelt assumed office for the first time in early 1933, he was elected to office in 1932, he declared the banking holiday. Immediately, it was his very first act of office, and according to one historical account I read, he declared it literally 15 minutes before he was president of the United States. It closed all the banks, and it closed all the banks for about 10 days so that they could do an assessment of the damage and figure out how to repair the damage. And so when the banks opened, I think 10 days later, then 1/3 of the banks that had been closed were gone and never seen again. Another 1/3 was merged into the largest 1/3. And so 2/3 of all banks disappeared in the United States in 10 days. And that's obviously a very serious development. From that generalization, we can say that deflation undermines any economy with large levels of debt contracts in nominal amounts, which is to say amounts not adjusted for prices. So that's the primary problem. It threatens the financial system because it threatens the integrity of established loans. Today, it is a problem in some nations. If you're in a commodity export nation, this can be a problem in that nation for you. So especially if you're doing raw materials exports. So we have some commodity deflations in the modern era quite frequently. As I am recording this, there's an acute commodity deflation in crude oil right now. This is being recorded at a time when the stock market was falling 3,000 or 4,000 points and oscillating in some days 1,000-point swings, and all during that period crude oil fell from about $50 a barrel down to today's price, I think, of $42 or so. And that causes stress for that industry, of course. Now, this is an old graph I use from the BLS that shows the CPI annualized monthly rates from 1920 to 1940. And you can tell, it's kind of interesting here, you can tell there wasn't two deflation. I mean, there wasn't one deflation, there was two. And the Great Depression deflation that I'm talking about is the second one there that's labeled the Great Depression. The first one also caused some problems, but we quickly rebounded from it, and it was kind of a counter to the inflation of World War I. In World War I, the United States had become the breadbasket for Europe because so much of the European war was fought on farmland in World War I. So American farmers were exporting farm products, especially grains like wheat, to Europe to feed Europe while it was at war. And that substantially elevated the prices of farm products during the war. After 1919 and the Treaty of Versailles, the war was ended, the prices rose for a little bit longer, but because the market instantly dried up with the treaty, then the prices plunged, and they overcorrected. They went all the way through the zero inflation level, as you can see, and there was a couple of years where prices fell by 15%. But that was temporary, and at that time, farmers had plenty of cash probably left over from the prosperity years of World War I, and were able to weather this. Then, of course, we went into what was called the Roaring Twenties, and this is a time when manufacturing was getting its first foothold in America because some of the automobile manufacturers, in particular Ford Motor Company and eventually what was to become General Motors, began to manufacture cars, the first appliances, and those companies that manufactured them began to appear in the 1920s. So it was a time of relative prosperity, a time of relative moderate prices. As you can see from, say, 1923 on, there was price stability. And it also, of course, as you know, was a time of speculation. And then finally we had the stock market crash in 1929, and that was followed by a brutal depression called the Great Depression. And it pulled prices down, and you can see that these, of course, are annualized monthly rates. So if you have annualized monthly rates at a level of -10 for many months in a row, then the price level itself is falling on net about 25%. And some agricultural products fell a lot more than this. And as I say, we're an agricultural economy, and this caused very, very widespread suffering, especially financially. Foreclosures, the Dust Bowl, the migration west. Steinbeck novels describe this in considerable detail, like the Grapes of Wrath. The migration away from the farm areas and the bankruptcy. And so the stories of the Great Depression are substantial. Now here, for example, looking at two commodities, we can kind of see the behavior over World War I and the Great Depression, because that previous graph only started in 1920. So this is the price of corn and wheat during World War I and the Great Depression in dollars per bushel. And so the orange line, the bottom line, represents corn, and the green dotted line represents wheat. And so as you can see, from 1910 to 1914, both were below $1 a bushel, wheat just barely, and corn considerably, being 55, 60 cents or so per bushel. And the war started in 1915, late 1914, I think. And as a result of the fact that, again, we were feeding Europe at a time it was fighting World War I, you can see that wheat prices increased from below $1 a share to well above $2 a share. So this was a time of tremendous prosperity for American farmers, because prices in the United States on whatever they had to buy was not rising alone. I've read that agricultural land started to rise in value, as often happens during this sort of incident. And then, of course, corn also rises pretty much proportionally to $1.50 a bushel. As soon as the war ends, then the price of these commodities don't instantly collapse, but they come down quickly. By the time 1 year has passed, or a year and a half or so has passed, and we've got wheat back down to $1 and corn back down to 50 cents. But those were sort of levels that we had seen before World War I, and that wasn't very harmful. And it was also the case that farmers were in pretty good shape back then because of the money they'd made by selling wheat in the First World War. We go through the 20s with a lot of stability, and there weren't many problems in farming. And then, of course, the Great Depression effectively starts with the stock market crash in October 1929. And now these prices really come tumbling down. You can see wheat falling to below 50%, not 50%, 50 cents. It had been $1. And corn also falling below that level. Wheat, of course, really took the brunt of this, as you can see. And so this is what triggered off very high levels of bankruptcy. And that alone provides us a significant lesson from the effects of deflation in the Great Depression. It came at a tremendous human cost. It wasn't just grains, of course. It was agricultural products across the board. And in 1933, this was highly dramatized by dairy farmers in Wisconsin. I think I read that Wisconsin's domestic product in 1933 was 80% provided by dairy farms. Dairy farms provided about 80% of the employment in Wisconsin. So, of course, the price of milk also plunged in the same period that we're talking about. The farmers went on strike to try to, actually decided to destroy milk, to try to drive the price of milk up. And the National Guard was called in, I should say, to try to reserve order. There was a number of deaths and a number of riots and the like. This is one of the many scenes or pictures taken from that era. And here, dairy farmers are clearly pouring milk out, partly as a protest to what they regard as their unfair treatment by the government, the low prices of milk. To some extent, they regarded this also as unfair treatment by railroads and creameries, and they therefore went on a violent strike and destroyed a lot of milk. And so that's one of the human side effects of the Great Depression and its deflation. Now, when we move up into 2016, you say to yourself, well, come on, is deflation a problem in the modern era? I mean, when you grew up, you're an old man, and inflation was that the talk of the town? And no, it wasn't. I was thinking today that when I first started being aware of economic issues, which was in the late 50s and certainly into the 1960s, the Great Depression was only 20 years old by then, the end of the Depression, which really came with the beginning of World War II. So 1940 is pretty much the end of the Depression. We came out of the Depression because of the fiscal effects of the Second World War. As soon as we went to a wartime footing, the Depression was over. But I remember that my grandparents and their relatives, they're thinking about everything, and especially all economic matters and financial matters, was completely dominated by their memories of the Great Depression. They talked about it a lot. They regarded Franklin Delano Roosevelt as a hero. I had some relatives that lived in Lindsay in a big Victorian house, and in the living room they had this enormous portrait of Franklin Delano Roosevelt hanging over the fireplace. And even my parents' generation had some lagging memories of growing up young when the tragedy of the Great Depression was there. But by the time we get to the 70s, nobody's talking about deflation anymore because nobody believes that it's possible in the modern era. And then after the recession of 2008, which was a global recession ultimately, prices did start to dip down into very low deflationary levels. They didn't fall much below the 0-point line, but they did fall below the 0-point line. And of course, key commodities fell substantially. Remember when we looked at the mapping of the producer price index, it was very volatile and was then, is now. So even if the general price level as measured by the CPI didn't get down into negative numbers, those PPIs often did. And so we began to fear deflation to some extent and realize it was a possibility. It really began in Japan because we learned in Japan which had a pretty bad recession at the time, that corporations in a deflationary environment actually find it profitable to hoard rates, to hoard cash at very low interest rates, and like 1%. But real 2% if inflation is 1%. So you say, well, why would anybody hoard cash if the interest rate is 1%? That's because the deflation rate is 1% negative, and so the effective return on that was 2%. And if deflation goes to minus 3%, then of course your rate of return on a 1% nominal yield is 4%. And they also felt that putting this money at risk, creating capital goods that will manufacture commodities that will fall in value because there's a deflation underway, was not a good idea. So corporations in Japan slowed down their spending a lot and just hoarded their cash. In Europe, the all-important real estate and durable goods sales tumble with deflationary expectations right down to zero. And we saw German Bundesbank 10-year note rates drop into negative interest rates. And then again, corporations here don't like deflationary environment if they have sticky wage contracts. That should say sticky, not stick, wage contracts. And these deflationary expectations puts relentless downward pressure on nominal interest rates, even pushing them into negative territory, which we will look at a little bit later. And we already have made note of the fact in this class that even right now, and this is recorded in 2020, that the 10-year note rate in Japan and the 10-year note rate in Germany is currently negative between 0 and minus 1%. And it's been like that for quite some time. Now, we're going to come back to deflation when we get to monetary policy, but right now this has given us an opportunity to talk a little bit about what it is and what some of the worst features of it are. So let's go talking about now the second half of this, which is a discussion of theories of inflation that we have looked at. And let's remind ourselves of what we've seen so far. First of all, we have the aggregate supply, aggregate demand model. And with that model, we saw that inflation can be demand pull or cost push. We saw that the impact of the variables upon inflation depends upon the context. And we saw that inflation tends to get worse automatically. So let's review those in the aggregate supply, aggregate demand model very quickly. And then secondly, when we take a look at the loanable funds model, we saw that inflation and interest rates are correlated, and to cure inflation, interest rates must rise. Now, I haven't really strongly made that point yet, to cure inflation, that interest rates must rise, but it turns out that's true, and you maybe have seen that association so far. I did say it a couple times that it wasn't a major part of the theory. So let's move on and actually review those. So here's what we learned. The point that the inflationary effects of any surge in aggregate demand depends upon context is clearly represented here, right? If you have the aggregate demand curve at the point where the aggregate supply curve turns sharply upward, which again, remember, we associated with the capacity utilization rate related statistics being at about 85%, then a stimulation to aggregate demand can have strong inflationary effects. If, on the other hand, it is back further where it says there's some growth but mostly inflation, if AD1 were back going through that language right there, of course, a stimulus moving out is not going to have inflationary repercussions because you're beginning at too low of a point on the aggregate supply curve. This is typically the case when you are coming out of a recession where such metrics as a capacity utilization rate has fallen back to, say, 65% or so, as it did in 2009. When we did some modeling, of course, we reminded ourselves that once inflation happens, once it starts, it has this automatic tendency to get worse, and we know that's due to inflationary expectations. We spent some time justifying why people would change their behavior. And remember, one of the examples we used was real estate. If you began to experience adaptive inflationary expectations and see housing prices rise, This might tend to encourage you to accelerate your own demand for a house or the effort to purchase a house so that you can buy it before it inflates away and you can't ever afford it. And this kind of collective behavior in an economy can actually continue to shift the aggregate demand curve out due to inflationary expectations, which is that feature of inflation that makes inflation worse, that compounds the problem. So that we saw in the model. Now, we also learned, remember, this is a copy of a slide we had before, that sometimes, strangely, you can get a combination of very high inflation during the trough of a business cycle. Intuition would say it should appear at the peak of a business cycle. In fact, the original pathology of the business cycle discussion said that if you are nearing the peak of a business cycle, that raw materials are getting scarce, labor is getting expensive, and that's why the Federal Reserve reacts to that. But we also allowed for historically the possibility that inflation can peak at the trough of a business cycle as well. So again, what was our explanation about that? Well, when we used the model, we pointed out that that kind of inflation is called stagflation and usually is a variety of cost push inflation. And it's no coincidence that those two inflationary spikes happened right during the times of the OPEC oil embargoes. And there were other shortages in the economy at the same time for various reasons. And so in this kind of model, that is shown as cost pressure rather than a stimulus to demand. And remember, in the context of the model, it shifts it back from AS1 to AS2, as it says here, due to severe cost of increases or supply side shock like the OPEC oil embargo. Now this, of course, as you can see, moving the equilibrium from A to B is going to not only result in a decline in real GDP, and by definition, that's a recession if it lasts for 2 quarters or more, but at the same time, prices are rising, and they're happening simultaneously, as I said, at the same time. And so this is the type of inflation, stagflation, that actually shows inflation at its worst during the trough of a business cycle. And of course, that's a terrible situation to be in, and we were in it twice between 1970 and 1990. Also, finally, this was what I call the European problem, because the power of labor unions to enforce wage gains that could not be paid for sometimes caused problems in Europe in the 70s and 80s, or mostly the 70s. And we said if you have wage increases with no productivity gains, then you have a shift out in demand because of the wage increases, and you have a shift back in supply because of rising labor costs. And so you have the equilibrium movement from E1 to E2, and that, of course, is no economic growth and pure inflation. It's not an example of bad socialism, it is an example of bad socialism, but it's not emblematic of all socialist experiments. You can look at varieties of socialism where wages are stressed in Northern Europe, and you can see multiple examples of how they've made it work without having inflation as the result of it. Now, one of the ways you can make this work is get productivity gains. And again, I remind you that that's largely your job if you're going to be an engineer or a scientist, because the productivity gains largely come from the use of technology in application of labor. And with the era of self-driving vehicles coming on, this is going to certainly happen in your lifetime, and probably not entirely in mine, but probably when you're 30 or 35 years old, the self-driving vehicles are going to be everywhere. And the application of robotics is increasingly widespread. I just saw another example today of a company that's making robots to specifically work in fast food restaurants, doing things like frying French fries and flipping hamburgers. And this robot isn't very expensive, and it's really, really reliable. And so you can see multiple examples of productivity gains making it possible to increase wages for people who still have jobs. Okay, I think that is enough of an overview. What remains here is one more module, part 4. It's also relatively brief like this one. Remember, the core explanation was part 2. I was actually filming that when I didn't feel very good, so it wasn't very well done, but it's going to have to be acceptable in this rather troubling year of 2020. You may recall, if you ever look at this in the future, which you probably won't, but if you ever do, that this was happening at a time when the coronavirus was a threat to the college and to everybody, and we were all trying to figure out what exactly we needed to do about it. So, okay, we'll post up the 4th lecture fairly soon, and we'll be done with this and moving on to discussions of employment and unemployment.